Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Thursday. It's December the 30th. The market's going to be opening up in about, an hour and 45 minutes or so, give or take a minute. We've got the last trading day of the week of the year tomorrow. Markets are very, very subdued right now. Volatility, liquidity. Well, liquidity's kind of low, but volatility is not that bad. More so, markets are actually more volatile than I've seen them last couple of years, last few days of the year. And we are, in fact, having the January effect. Now, I've had a lot of questions asking me how long asking me how long this January effect will last. Typically, usually, statistically, I don't have a crystal ball, but usually it tends to last about 2 days into the New Year's. Sometimes more, sometimes less, but the average is first 2 days of New Year. So hopefully we'll have a rally the beginning or into the middle of next week. I'm hoping that's the case. As far as Fed news, we had international trades in goods and services. The data was not all that bad yesterday. It was kind of glossed over, but it was actually fairly reasonable. Jobless claims is today. Now, I'm not going to make a big deal out of this report because the report has been very, very solid. Jobless numbers have been below the moving average now for a very, very long time. The consensus is now 200,000. The 4-week moving average is 206,000. This report has been very uneventful for the last several months because the numbers have been coming out okay. Then we've got the Chicago PMI number. That's the producers, managers index number, and that's going to reflect on the supply chain issues and the bottlenecks. After a lower than expected but still very strong November, Chicago PMI is expected to edge up to 62. If it edges up to 62, the things are looking better than we expected in terms of manufacturing, international, non-manufacturing, international and non-international local manufacturing companies. And it's going to be very, very interesting to see what the manufacturing world has to say, and it'll be very impactful to see how the supply chain will impact New Year's. A lot of people spend money on New Year's. Now, the bond market, as I told you yesterday, or actually as I told you for the last several days, it looks like it wanted to break down. This is a descending triangle. Typically, when it's a descending triangle, we have a down breakdown. When we have an ascending triangle, which we do not have right now, the ascending triangle would be the opposite. It would be a flat top and an angled bottom. So the bottom would go down and the upper part would be flat. Let's see if I could show you let's see here. Let's see if I could whip out a descending triangle here. Let's see here. No descending triangles here. I'm sure one will come up, but it looks opposite of this. But the bottom line is descending triangles typically break down. We broke down yesterday. We may go up a little bit today because yesterday we went down quite a bit, about 1.62, which is over a handle on bonds, which is fairly significant, especially on a random market. I'm expecting it to come down just a bit more, maybe another point. We have a position that we need to roll over into another month or get out of, so I'm hoping to do that over the next day or two, especially if the market continues showing strength. That should happen. One of the reasons why, let me just say this, one of the reasons why we saw this upside move was because of the Omicron, the big O variant, and it's looking like it's not as impactful into the economy as we expected because people are getting sick, but they're not getting all that sick. It's very contagious, but they're not getting really sick. So the bond market's now retrieving back down. It's not doing its flight to quality. It looks like the sentiment is getting a little bit better. Speaking of sentiment, if you look at the put to call ratio, I'm a little surprised. Market's been really bullish, but it actually went back up, which means the market has more upside to go. This means that when it moves up, that means market is getting more bearish. But I don't see how the put buying could be increasing in light of what's going on unless market participants are expecting a really nasty sell-off, a really big rally, because the more we go here, the more bearish the market gets and the more it turns over. So I'm not seeing that really the case. I was surprised. I was expecting this rally to continue. I mean, this downslope to continue, bringing us down to here, and then the market being overbought. But it's coming up here which is a sign that the market's actually getting oversold, which is kind of odd. But that's bullish for the market. If it goes lower, once it goes here, the market turns around. Once it comes here, the market goes higher. So the market's actually set to go higher. And if you look, oh, here's an ascending triangle. So this is a ascending triangle. I was looking for an ascending triangle. So this is a descending triangle. And this is an ascending triangle. As you can see here, flat top, right here, flat top with an ascending up. Prices usually move higher, and I'm expecting prices to move higher. They're up about 119 overnight, so we should break out above this level. In terms of the heat map, I wanted to show you on a one-day basis what we were seeing yesterday. Retail, shoes, people are buying. Commodities, REITs, defensive. Not too defensive, more defensive, not defensive. So mostly like 8 out of 10 sectors that went up were defensive, but there are still, in other words, 8 out of 10 sectors that are moving are defensive, but we are seeing some, a glimmer of hope on speculative activities with computers and with the top 100 stocks. Now, if you look at it over a 5-day basis, again, very defensive, mostly defensive. Computers are here, but mostly outside of computer networks. And by the way, computer networks are defensive because when we have a stay-at-home environment, we tax computer networks more. So don't just think computers means NASDAQ. No, computer networks is actually defensive. But you got semiconductors here over a 5-day period. Still up here, holding up top 100 stocks, outsourcing, staying at home. So markets are mixed in terms of the defensiveness of sectors that are going higher. But if you look at each of the 11 sectors, and we'll look at them in detail in a second, you will see that over the last 30 days, healthcare, consumer staples, utilities, real estate, technology, chips, material, not discretionary, not clothing. So again, things are a little bit, markets have a heightened sensitivity to risk right now. So you've got to be very cautious. My advice for you guys is to keep your eye on the Dow Jones, because the Dow Jones has a very good mix of different stocks and different sectors. If it continues breaking up, if it breaks above, and we also have an ascending triangle there or an ascending triangle here, depending how you look at it, but they're both ascending triangles. The bottom line is I'm expecting more upside from the indices, especially if the jobless claims are good, especially if the manufacturing numbers are solid, and I think they'll be okay. Now, what you need to pay attention to is individual sectors. Let me go back to individual sectors. And here's how they shake out. Look at consumer staples and utilities. Tell me it's not almost an identical chart. Look at these two, right? They almost look identical. Look at real estate. These are very defensive sectors, and they're rising right now. Healthcare, it's a defensive sector. Technology looks like it's struggling at this level, but it looks like it can go higher. I don't think so. I think technology is going to cool off. Basic materials just broke out. They look great. A lot of Dow stocks, basic materials, blue chips. Communication sector, I think, is going to take another dump to the downside. I'm not seeing a major breakout there. And if we're already cooling off with the markets making all-time highs, imagine what will happen, how much pressure will go on the sector when the market actually cools off. Industrial, just like basic materials. I wish I could flip these closer, but I can't. But look at industrial and look at basic materials. That's a defensive rally, just like here, just like here, just like here. That's a defensive rally. Financials, because if this O variant stays running amok, Fed won't raise rates and financials won't go higher. So that's why they're kind of cooling off right now. Consumer discretionary, folks, I'm telling you right now, didn't take out all-time highs like tech did, and it looks more to me like communication sector. So if it's already kind of topping out or looks like it can't go higher when the market's making new highs, imagine what will happen when the market starts cooling off. So I'm increasingly becoming bearish on the consumer discretionary sector. Energy, I'm a little surprised, but again, if interest rates don't go higher if interest rates stay where they're at because of the O variant, and I don't think that's going to be the case. I think they will go higher. But if they don't go higher, financials and energy will if inflation is done, then financials and energy will peter out, but I don't think that's the case. But I would be very, very cautious with consumer discretionary. And by the way, I want to talk about something. Today is Thursday, and on Thursday I give you my top ETF and the option. And notice how much I like the real estate sector. It was trending for a while. Now it's breaking out. I still like it. I'm very bullish on real estate. This RES, R-E-S is the ticker symbol. It's residential and multi-sector real estate ETF. And just to show you this, how this ETF has been responding to the current market environment. Pretty good, right? Not bad, right? So I like this ETF. I'd get in. I'd wait for a little pullback, maybe to the 95 level. If it breaks the 50-day if it breaks down to the 88 level, I would get out and I would keep holding it for the next quarter. As far as the option, I really like the January, February, March, April expiration. It's got a good 105 days left. And on a call side, I would go with this one right here. There is some volume on here, actually, so you can actually get a bid and offer. And I would work the offer. I would start at $4.50 and just go higher by about 10 cents. In my opinion, 95 strike price. It's at 97. It's just a little bit in the money. So again, not expensive. There's not a lot of premium in here. Volatility is not high. It's at 17%. This would be a good option. And again, it's traded last at 480. So I would start at maybe 440, 450 and work up slowly. This is not a very high flying asset. So again, residential multi-sector ETF, be cautious right now. Pay attention to the bond market and pay attention to the Dow Jones. Those two things should give us a really good feel for where we're going, and also keep an eye on the sectors. This heat map is very valuable right now, especially over a day, so you could see exactly the type of stocks. And I would only focus on the top two lines here and the bottom line here, because then you could see exactly what's really moving higher and moving lower. So as you can see here, retail is not really doing all that well. Internet is not really doing all that well. But defensiveness is. Now, I've got something really, really exciting for you. Right now, I'm airing a very critical briefing to help traders navigate markets heading into the New Year's. But it wouldn't be very nice of me to only tell you which stocks to stay away from, right? I want to give you the whole thing, which is why in this class, I'll share with you top 3 favored buy signals right now. Consider it a way of saying thank you for following along with my work, because your success is my ultimate goal. I want you guys to do well. I really care about you guys. Click on the link below to access this value-packed training to prepare yourself and your friends, family for the New Year's. I want you guys to make money next year. That is my dream goal. I want you guys to be successful, and I want to guide you guys on the right track. Follow the link below. I included it in this video. Get in on this now. There's no catch. There's no fluff. You guys got to check it out. Follow the link below. Learn all about Turning Point 2022. You guys are going to love it. And again, there's no fluff. I promise you. If there's fluff, I dare you to send me an email and tell me there's fluff and you didn't get something out of it, because I think it's good stuff, good material. And keep your eye on the bond market and on the blue chips and on the sector heat map. And by the way, you can look at the sector heat map. If you go to bar chart, you can look at it on the first page right here. It'll give you a nice little briefing of what's going up and what's going down. And as right now, as you can see, real estate's the #1 sector. So RES, R-E-S, we're going January, February, March, April, and we're going to the 95 call. Hope it helps. Follow the link below. Check out Turning Point 2022. All meat and potatoes, no fluff, no Ferraris, no lifestyle stuff, just trading, which is what 2022 is going to be all about. Bye, guys. Have a great day, and I'll see you tomorrow.